Bull Bear Buzz podcast for decoding markets, fueling minds. Welcome to the deep dive. Today we're really digging into India Inc.'s earnings growth. What's the real picture?
Yeah, there's a lot of noise out there.
Exactly. So we've got analyst notes here from Standard Chartered, Kotak Institutional Equities. Quite a bit to unpack.
And we're also looking at the bigger global context, right?
That's right.
Trade tensions, what's happening with oil.
Absolutely. Pulling in insights from Reuters and other sources on that front. The mission today, for you listening, is basically to cut through that noise, get a clear, concise view of the current outlook, potential challenges, and importantly, how these things, earnings, trade, oil, are all connected.
It's definitely all linked. Okay, so where do we start? The earnings picture itself.
Let's do that. Are these recent Q4 results, a sign of a bigger slowdown? Or maybe just a temporary dip because of all this global uncertainty?
That really is the key question, isn't it? And what's striking is the level of caution we're seeing creeping into analyst reports. It's not just one voice. It feels like a growing chorus highlighting potential bumps in the road for India's earnings.
Okay, like Standard Chartered. They downgraded India equities to neutral. That felt significant.
It did. And they pointed specifically to policy uncertainty, mostly those U.S. tariffs we keep hearing about.
Right. Creating volatility, making the risk reward less appealing, basically.
That's the gist of it, even though, interestingly, they still see the Nifty 50 hitting 26,000 in about 12 months.
So still some upside, about 7% maybe, but
yeah.
Tempered enthusiasm?
Exactly, tempered by those global headwinds, which ties into what Kotak Institutional Equities, or KA, are saying too.
KIE. They think the market's maybe a bit too cheerful, a bit complacent about earnings estimates.
That's their view, yeah. They're looking ahead to FY26, FY27, and thinking with potential slowdowns globally and maybe domestically, we're probably going to see more earnings downgrades coming through.
Okay. Do they put a number on it?
Their current model pencils in about 12% net profit growth for the Nifty 50 in FY26. But, the tone is definitely cautionary.
And this isn't just forecast, right? There's actual data backing this up.
Well, yeah. Look at the Business Standard analysis. They looked at 175 companies for Q4 FY25.
Okay.
And the combined net profit, up just 3.8% year on year.
Wow, 3.8%. That sounds low.
It is. It's the slowest growth pace in 17 quarters, apparently.
In 17 quarters. That's over 4 years.
Right. And what's interesting is the contrast with sales. Net sales grew 8.5% year on year.
Okay, so sales are growing faster than profits. Significantly faster.
Yeah, sales growth was up a bit from the previous quarter, but still way down from the 11% growth we saw in Q4 the year before that.
So sales up, but profits lagging. What does that suggest? Pressure on margins.
That's certainly what it looks like, something squeezing profitability.
And Key digs into specific sectors where this might be happening.
They do. They highlight export-focused areas. Think automobiles, IT services, maybe even pharma and specialty chemicals down the line.
Because of global growth worries and those U.S. tariffs again.
Precisely. They're asking if the market optimism in these sectors really reflects those risks adequately.
Let's take autos. How do the tariffs play out there? I mentioned Tata Motors.
Yeah, it's a good example. Because they don't have large manufacturing bases in the U.S.
Right.
Those high U.S. tariffs hit their exports directly, makes them less competitive compared to companies building cars stateside.
I see. So it creates an uneven playing field. That directly impacts potential sales, potential earnings.
Exactly. It makes that global policy impact very, very real at the company level.
And IT services. What's the concern there?
It's partly about clients potentially delaying decisions. If there's economic uncertainty, big IP projects might get pushed back.
Okay, that makes sense. Direct hit to revenues.
Yeah. And KI also flags the valuations. IT stock valuations are, pretty high compared to before the pandemic.
Higher growth rates baked in already.
Seems like it. And those high valuations might not be fully accounting for the risk of a, let's say, serious U.S. slowdown or even a recession.
Okay. What about domestic consumption? Surely that's a safer bet.
You'd think so, but Kadri raises a question there too. Companies have benefited from lower raw material prices recently, right?
Yeah, that helped margins.
But the question is, can they keep those benefits? Will competition force them to pass savings on to consumers via lower prices?
Ah, okay. So maybe the market's expecting too much of that cost saving to drop straight to the bottom line.
That's the potential risk they're highlighting. Profitability gains might not be as sticky as some hope.
Okay, so we've got these worries stacking up around India Inc.'s earnings, global factors, sector-specific issues. But like we said, it's not in a vacuum. Let's talk about the global trade picture and the oil market, because that seems tightly linked.
Absolutely linked. And we saw some really dramatic moves in oil prices back in April.
Yeah. What happened there?
Well, prices fell pretty sharply. It was actually heading for the worst April performance on record for oil.
On record? Wow.
And if you connect the dots, it looks like another sign that this U.S.-led trade stuff, it might actually be starting to bite into global economic growth.
And therefore, energy demand.
Exactly. Less economic activity, less need for oil.
Got numbers on that drop.
Yeah, Brent crude, the global benchmark, it fell towards $64 a barrel. For the month of April, it slumped over 14%.
14% in 1 month.
Yeah, the biggest April drop since, wait for it, 1988.
Goodness, a long time ago. And U.S. crude, WTI.
That was down too, hovering near $60. And adding to that picture, the American Petroleum Institute, the API, estimated a rise in U.S. crude stockpiles.
More supply sitting around.
Yeah.
Suggests weaker demand, right?
Typically, yes. About 3.8 million barrels increase, they estimate.
So the Trump tariffs, especially hitting China, a huge energy consumer, that's weakening the demand outlook.
That's the interpretation, yes. And then you've got dynamics on the supply side, too.
Like OPEC.
Yeah. Talk of OPEC maybe loosening its output curbs. JP Morgan Chase even warned supply increases could accelerate.
More supply coming online just as demand looks shaky. Not great for prices.
Not ideal, no. And reports also suggested Russia increased its oil exports around that time.
Okay, so a combination of factors pushing prices down. Did they drop further recently?
They did dip again, hitting a 2-week low.
Okay.
Again, linked to those OPEC output expectations and just the general worry about the trade war.
Where did they settle?
Brent ended up around $64.25, since WTI around $60.42. Lowest since April 10th, I believe.
And this trade war concern. It's not just about oil demand, is it? There are wider fears.
Oh, definitely. There was a Reuters poll around then. A majority of economists surveyed actually thought Trump's tariffs made a global recession probable this year.
Probable. That's a strong word.
It is. When you've got the world's two biggest oil users, the U.S. and China, hitting each other with tariffs, it's almost inevitable analysts start cutting their forecasts for oil demand and prices pretty sharply.
I remember seeing a quote. Was it Bob Yager from Mizuho? Said something quite stark.
Ah, yes, he did. He basically described the U.S.-China trade situation as nearing a semi-embargo.
Semi-embargo, wow.
And warned about the growing risk of global demand destruction. It really paints a picture of how serious this could get.
And we're seeing real-world consequences beyond just market prices, right? On trade figures, on companies.
Absolutely. The U.S. trade deficit in goods actually widened in March. Why? Businesses were importing stuff before new tariffs kicked in.
So trying to beat the clock, but that actually dragged on economic growth in Q1.
That's the suggestion, yeah. And then you have companies reacting. UPS announced, 20,000 job cuts?
Yes, saw that.
And General Motors pulled its financial outlook, both citing trade policy uncertainty.
That's pretty direct fallout.
It is. Although, interestingly, there were also whispers that Trump might issue an executive order to soften the blow of auto tariffs, maybe some recognition of the pain.
Perhaps. Meanwhile, other companies feeling the pinch. BP.
Yeah, BP, the UK oil major, reported a much bigger profit drop than expected, 48% down. Blamed weaker refining and gas trading. Another ripple effect.
So many ripples. And looking ahead, more potential supply pressure. OPEC meeting in June.
That was the talk, yeah. Some OPEC members might suggest further output hikes, which, given the weak market sentiment...
Seems like bad timing.
That's what Ole Hansen at Saxo Bank pointed out. Not exactly the best time to flood the market. And Kazakhstan apparently increased exports, too.
More supply. And U.S. stockpiles. Still rising.
The forecasts were for another small increase for the week ending April 25th. That would have been the 5th week in a row.
5th week? Yeah, that pattern definitely suggests demand isn't keeping up.
Compared to previous years, it reinforces those concerns.
Okay. Let's try and tie this all together clearly for you, our listener. How do all these pieces fit?
Well, it seems pretty clear that the global trade situation, especially these U.S. tariffs, is acting like a major drag.
On two main fronts.
I'd say so. First, it's dampening overall global economic growth, just making everything slower. That naturally hits demand for everything, including oil, and hurts corporate earnings worldwide, not just in India.
Right. Slower global growth equals weaker earnings potential everywhere.
Exactly. And second, the tariffs are hitting specific export-heavy industries directly. Industries important for India Inc., like we discussed, autos, IT.
Okay. And the oil market piece.
That feeds back in. Worries about global demand push oil prices down. Lower commodity prices can sometimes help companies by lowering input costs.
But maybe not if demand is also falling.
Precisely. And it also affects inflation expectations, which has knock-on effects for central banks, interest rates. It's all interconnected, like a web.
A web where pulling one strand, like trade policy, makes the whole thing wobble.
That's a good way to put it. The uncertainty itself is a drag. Businesses hesitate to invest. Consumers maybe hold back on spending.
Which leads back to slower earnings growth, which is what the analysts are starting to flag more strongly, and what the Q4 data seems to show glimpses of.
Exactly. The caution from analysts, the recent numbers, it all points towards a more subdued earnings outlook for India Inc., at least in the near term.
Okay, so summing up this deep dive, the outlook for India Inc.'s earnings seems, well, cloudier than perhaps it did a few months ago.
Yeah, subdued is probably the right word, driven by both domestic factors and the significant global headwinds, especially trade uncertainty impacting sectors and the oil market.
Analyst caution and the real possibility of more earnings downgrades are definitely key things for you, the listener, to keep in mind.
Which leads us to a final thought for you to ponder. Given how interconnected all this is, global trade, company profits, commodity prices, how could an unexpected shock in just one of these areas ripple through the whole system in the coming months?
Good question. What indicators would you watch most closely to see how this evolves? Something to think about. And just before we wrap up, a reminder. The information provided is for educational purposes only and not financial advice. We are not SEBI-registered advisors. Investing in stocks carries risks, including potential loss. Consult a SEBI-registered advisor before deciding. We are not liable for any losses from decisions based on this information. For more unbiased market updates, please subscribe to Bull Bear Buzz Podcast.